2022 has been a mess for long-term investors globally. Few asset classes have positive returns, and if they do, they have huge volatility. What's the culprit? Treasury bond interest rates are increasing at the fastest pace in decades. Take a look at the change in the Fed funds rate chart on how fast the Fed is raising rates versus prior cycles. Over the past 40 years, only Greenspan in 1994 comes close. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas, and this is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise for your money? This week, we're talking about last week's FOMC news conference.
Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal.
Chairman Powell essentially said, and I'm paraphrasing, we're raising short-term rates by 75 basis points to a range of 3 to 3.25%. We have inflation fight in our sights. We're okay with an economic slowdown or worse. Our inflation fight is far from over, but we'll get it under control. Damn the torpedoes, full steam ahead. With those words, the computers took over trading the Fed's dot plot, which is their interest rate forecast. Those computers sold stocks and risk assets because the Fed was more hawkish than markets expected. The FOMC talk suggests another 75 basis points and 50 basis points in hikes this year, taking monetary policy into the very restrictive place. Stocks dropped, commodities dropped, and credit spreads widened. This is at the same time the two things that investors really want to see peak before getting excited about risk assets moved higher on the day. What are those two things? First, the dollar hit decade highs versus almost every currency in the world. We've discussed this previously. While great for traveling in Europe and Japan, it's bad for the S&P 500 overall as it hits corporate revenue growth and earnings. Here's a chart of the DXY, which is the dollar index. It's up and to the right, which remains bad for most stocks in big US-based indexes. This is All-Star Chart's overlay of the broad 3,000 stock NYSE Composite Index against the dollar. It's still pretty clear. The broad market needs a top in the dollar, still thought of as the world's safety currency, defined as sustained low in stocks. And the second asset that hit new highs in yields and lows in price are real interest rates, also known as TIPS. Here's a chart of 10-year TIPS yield for the last 12 months. It too is up and to the right. This has been pressuring the overall stock market for all of 2022, except during those two brief rally periods in late March and then again in mid-June through mid-August. What do those time periods have in common? Well, back then, the market looked at real-time inflation data, which has been slowing and rolling over. It looked at that data and the market anticipated the Federal Reserve would slow the pace of their rate increases. Both times, the market has been disappointed and stocks reversed course and sold off. Remember, the Fed's dot plot has a very poor track record in predicting exactly what the Fed will end up doing. As we've discussed many times over the last 4 years, the Fed's fund future has been horrible at predicting the future. Only a year ago, the Fed dot plot and Fed funds futures said the Fed would raise rates once or twice in 2022 to about 75 basis points. The Fed has already raised rates by 3 times by 75 basis points at a time over the last 3 meetings. If you want 2 real-time tradable assets to watch to figure out if and when the S&P 500 is troughing, keep these 2 indexes on your screen. Those 2 indexes, the US dollar index and one of real interest rates or tip yield curves. The dollar affects corporate revenues and earnings, and that real interest rate yield has a huge influence on stock valuations. So what does all this mean in terms that a retiree or near retiree can understand? Does the Fed need to cut rates to get stocks moving higher again? No, I don't think so. But what they most definitely need to do is slow the pace of their actions down and let the economy and the markets absorb what they've already done year to date. Stocks and markets can handle higher interest rates, and history proves that. Here's Ben Carlson's data showing average stock returns during different interest rate and inflation periods since 1928. The best environment? Past peak inflation. It tends to be the speed you drive, not the path you take, that causes car wrecks on the way to your final destination. The market wants the Fed to mind the speed limits and let the economy catch up to their initial interest rate moves. Are you trying to meet your needs or your greeds in retirement? Give us a call here and schedule an initial consultation with an Oak Harvest advisor. We will sit down with you and help you and your family do the math to figure out if and when you'll be able to meet your retirement goals and needs. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain, and that's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. The first one is free. We are here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and for the whole team here at Oak Harvest, have a blessed week.